set a challenge here to get you fully equipped for your fundraising round in 15 minutes. So we're going to try and do the best job we possibly can. So firstly, to introduce myself very, very quickly, given the mandate here. I run a positive impact consultancy that you briefly heard about from Stanford. And really, we look at positive impact businesses, and we especially provide services on fundraising. And in particular, I lead on that. So we know all about raising rounds, from incubating ideas and getting them their first check and their first grant, all the way up to 40 million plus rounds and beyond for large-scale infrastructure and across sustainability and social impact. And I think what I found really interesting with the panelists in our initial introduction to each other is that there's quite a unique set of investment products that are available in this region, and we're going to hear a bit more about them. In particular, the Southwest investment funds and how they're being dispersed, and that will be from Anna and Rachel, and then from Rob, who has a very interesting background in family offices and in VC as well. So to kick it off very quickly, I'd like to kind of get into what's available for Cornish companies specifically. And if you don't mind, Anna, I'm going to start with yourself. So if you can explain a little bit about the Southwest Investment Funds and how they are being dispersed under FSC, which is a very well-known group, and exactly under yourself. What have we got available to us?
Okay, hi everyone. So I work for the FSC group. Some of you might have heard the name because we have been deploying investment funds here for more than 5 years under the brand name Cornwall Slush'D Investment Fund. So that was a 40 million investment fund, regional investment fund that had two baskets, basically a loan and an equity basket to be deployed in the region. The newest fund that we are working on behalf of the British Business Bank is called the Southwest Investment Fund. So if you're not kind of familiar with the investment funds by the British Business Bank, I would suggest go on their website and have a look, because there's some really interesting products and help that is available. In a nutshell, the Southwest Investment Fund, as the name suggests, is based in the Southwest. It's a regional fund. We look at startup to scale-up businesses. We offer two products. One is debt, large debt, so in the region of between 100,000 to 2 million. And the other product is equity investments, kind of in a nutshell, Dragon's Den type thing, where businesses come to us, pitch an idea, and then we assess this idea. And the investments there are again from 100,000 to 5 million. We don't do this in isolation from other providers. We collaborate very oftenly with angel networks or with other venture capital firms, and basically we help businesses grow much more rapidly than if they are to do this with a smaller types of investments or on their own. So this is in a nutshell.
Brilliant. And just to clarify for the audience, are we talking about seed or Series A, or is it quite a range of deployment capability there? So which stage are we talking about?
Okay, so because of the amounts, we usually will work with businesses that have passed kind of the idea stage. So we look at businesses that are at MVP stage, and we would like to see that market has been proven. So if you are offering product or service, you have managed to sold it, to sell it to someone. We are sector agnostic, and our usual investments are in kind of in this seed stage, going to Series A, and sometimes in Series B, although depending on the amounts, but probably seed stage is its predominant investment stage.
Okay, brilliant. And I thought it'd be interesting for the audience also to hear from Rachel, because she's dealing with some similarities of investment product, but at a very different stage. So can you talk to us about Swig Finance and exactly how businesses can take advantage of what you have to offer?
Yes, so at Swig Finance, we work very closely with the guys at FSC. We exchange sort of leads between ourselves if we need to. But at Sweek Finance, we do loans to businesses. So we do two main types of loans. Under the Southwest Investment Fund, we can lend from £25,000 up to £100,000. Again, like Anna, we're sector agnostic, so we can lend into any sector except for nuclear weapons and arms. We don't do that, but I don't think that will matter to you guys. We also do the government startup loan scheme, and the startup loan scheme might actually be of interest to you, because when we were having a conversation the other day, Rob made a very interesting point about borrowing under the startup loan scheme. The startup loan scheme is British Business Bank scheme from £500 up to £25,000. It's a personal loan that you put into your business. And why I think it might appeal for you kind of guys at early stage of business is that you can borrow a relatively small amount of money. So if you want to do some marketing, or you want to get a bit of tech kit or something like that to help grow your business, you can do that without giving away a share of your business. Yes, you've got to make the loan repayments, but it's finance that's there to actually help the business at a very early stage. The best thing I can say is, if you're interested in finding out what we do, come and talk to us. We're out there, and I'll be out there after this as well. And I was just going to give a quick example of something that I did recently. So I've recently lent to software as a solution, which I think you guys call SaaS, business it was up and running, but it was within a CIC, and what the owner wanted to do was take it out of the CIC and actually start running it as a profit business. So we were actually able to lend him some money to develop the product further so that it improved the market that he was aiming for, and sort of help him with salaries, with marketing, with some bits of equipment that he needed, because essentially he was setting up a whole new business and then moving on. So we do lend in the sort of sectors that you guys are looking at.
I think that's particularly interesting because at early stages, it can be quite difficult to unlock grants. We heard earlier that only 5% of grant applications were necessarily awarded. And here we have something different for very early stages of companies. So we'll certainly come back to you and find out more about exactly what you're looking for in particular to unlock that. But Rob, you had some really interesting points of discussion when we were catching up before this. In terms of your background, it's really family office and VC. So that's very traditional investment capital. In those kinds of environments, what exactly should startup founders consider in their approaches to investors, and what factors should they themselves look out for in your environment of family offices and VC investment?
Sure. So I started off working with a A-list music rock band running their family office, which was an experience that I can't share more about here because we'd have to probably have a few drinks. But after that, I went to create my own VC funds, and I've run my own funds in the most competitive market in the world, which was California, and then the least competitive market in the world, which is New Zealand. And kind of looking for the same thing. We're mostly buying equity in your company. I'm a pre-seed and seed stage investor. About 50% of my investments have been in companies just off the back of a pitch deck. So no product, no traction, just purely based upon the founder credibility and capability and potential capability, because that's what we're funding. So we're really looking to take equity in your company. At the pre-seed and seed stage, you should be giving up no more than 10% at the pre-seed and maybe another 10 at the seed. So they're not taking huge chunks of your company. They're taking a bet on the future. That can also be in the form of a loan. So it's called a convertible loan, which is basically an IOU that will convert to equity at the next round, or if you hit a certain milestone that they agree in the term sheet. There's also something called a SAFE, which was created by Y Combinator, and that is the difference between that and a convertible loan is that there's no interest rate. And that's because Y Combinator is Y Combinator and they can do that. But most of the time with a convertible loan, there's an 8 to 10% interest rate. And often there's a discount on the next round when that loan converts. So it's not free money. That loan might convert with a 20% discount on the valuation of the next round. So it's expensive. And that's generally about venture capital, is that it is expensive. but it's suitable for companies that are on or hoping to get onto a trajectory that will take them to the moon. Because we have that. We have to have that because, we typically run funds of 15 to 20 portfolio companies, and 10 of those will die, 3 will be okay, and 1 will make it. And so they have to be big outcomes. Things to look out for, I would be making sure, 1, you have a lawyer. That sounds expensive. And any lawyers in the room? That's a missed opportunity, isn't it? There should be. You need to be looking at things like anti-dilution rights. You need to be thinking about things like liquidation preference. That doesn't mean about what happens when your company goes into liquidation. That means what happens when your company creates a liquidity event. Or maybe liquidation, but let's say liquidity event, which is when you sell your company and you generate proceeds. Now, most of the time, the investors get paid first. And if any of you want a good case study, I can't give you too many for my portfolio because it would be wrong. But look at FanDuel. A company sold for 300 or 400 million, but the founders made nothing because they had to raise a lot of money to get to that point, and they didn't have any equity left, and so they got nothing. So that's the kind of thing to bear in mind. Veto rights. Some investors want control over what you do, how you spend. Again, those are things you need to be very careful. So the last thing on that is you just need to be really careful who you choose as your investor, because these relationships are like a marriage, but a marriage with a happy divorce, which happens after 10 years, which is when you sell your stock. And so you just got to make sure you're the right person for it.
Yeah, some brilliant words of wisdom there. And I think as well, you mentioned dilution, which really is another way of essentially providing you the valuation basis, i.e. having a strategy around your dilution moving forward, and really utilising that as the metric. The other thing as well is that some people make the assumption that family offices are going to necessarily give you a kind of term sheet, and that's not always the case at all. That actually, you need to look out for this stuff all the way across and all the way through. So kicking off the back of that sound advice, Rachel, what would be the best piece of advice for a startup founder in coming to you that they need to consider before raising investment?
I would say be prepared. So get all your ducks in a line, make sure that you've got a business plan, some forecasts, evidence to back up what it is that you're actually going to do. And bear in mind that someone like me, while I'm a massively experienced lender, I know very little about software development apart from the basic sort of stuff. So be prepared to explain it in plain English to people who might not be as techie as you are. But the most important thing is be prepared.
Actually, I would say that, a lot of the time, the startup founder's job is really to make it simple and understandable to the investor in all cases. And investors invest into multiple sectors. So they're learning at speed, at the pace that startups can be educating them on their expert subject matter material, right? So, Anna, same question. I'm sure you've got a lot of experience here in receiving decks and pitches and at a later stage of Series A. So what would be your piece of advice for startup founders pitching to you?
Okay, I really like what Rob said about the lawyer. I know that lots of people would want to save some money, but have that lawyer. So that's not my piece of advice, but really liked it. So I'm just trying to emphasize this. In my time, I have come across 2 types of founders. So the first type is the ones that are very self-assured. They come to you with a great idea. To these founders, I would say, just test that idea, not with your friends and family, but with the wider public, just to make sure that it's a product or service that actually can be sold. And the other types of founders are the ones that are scared. They think we sit on an ivory tower and we have some sort of a completely different language how we speak to people. To these founders, I would say pick up the phone and speak to us, because the worst case scenario, what's going to happen is that you'll get a no with an advice what to do. So my piece of advice is, if you are unsure, just pick up the phone and speak to us.
Last one for me would be, we're going to go through that in the next session actually, but the last one I haven't included in that is the question, why am I seeing this deal? That's the thing that runs through my mind. And if you've carpet bombed, the whole list on PitchBook and just hope that we're going to open your email, that's not going to happen. So how has it got to me? Has it been a referral from a trusted friend that we know? Is it from a founder in our portfolio? Is it you actually going through my website and submitting the pitch deck through that, which nearly always results in an email back? Little things like that. Why am I seeing this deal? Because, we're not chopped liver. Don't carpet bomb us, because it won't work. And definitely don't do LinkedIn emails. That will never work either. So just kind of, when you send your deck, kind of have a reason as to why this should be interesting to us, because
Excellent. I think we have 3 Ps there. So be prepared, pick up the phone, and prospect well. I'm going to add a little bit that the best way as well to get the best deal for yourself is to get as much interest as possible as well. So if you're going to involve lawyers, what's going to give them the most amount of leverage is having 2 or more investors interested in your company. So certainly applying all of that advice and then generating as much interest as possible and momentum is certainly hopefully going to get you that capital, and best of luck on your way.